Welcome back to the show. I'm your host Dame, and today we are diving deep into a topic that is simultaneously thrilling and terrifying for modern investors: algorithmic trading. You know the feeling. You run a backtest, you look at that equity curve, and it just climbs relentlessly. It looks like you've cracked the code.
Exactly, hostname. That rush, that initial euphoria is the most intoxicating and, frankly, the most expensive illusion an investor can buy. I'm guest name, and my job as a financial modeler is to confront that illusion head on. That perfect backtest, it's often lying to you.
The most expensive illusion. I love that phrase. Before we unpack the 7 devastating mistakes we're going to cover, let's set the context. Why does this matter now? Algorithmic trading has been around for decades, but why is flawed backtesting such a critical problem in today's market?
Because it's accessible. 10 years ago, building an algo was limited to big institutions. Now, with low-cost APIs and accessible data, anyone can do it. And here's the key difference. An amateur sees backtesting as an exercise in validation. They seek results that confirm their desire for success. A professional sees it as an exercise in falsification.
That's a powerful distinction. Validation versus falsification.
Think of it this way. The market is a vast, volatile ocean. Your algorithm is a ship, and backtesting is the initial resistance test simulated safely in port. If your shipyard, your backtesting, is flawed, that ship is absolutely going to sink during the first real storm, which is live trading. We have to stop optimizing for the past and start preparing for reality.
Core discussion: the technical traps. All right, let's start with the big one. The number one reason these perfect paper returns evaporate in the live market. I'm talking about overfitting. Explain this to our listeners using that great analogy you have.
Certainly. Overfitting is when your algorithm doesn't learn the underlying market rules, the general structure of the road, but instead memorizes the specific noise of the historical data. My favorite analogy is the tailored suit. If you overadjust that suit for one specific day, the exact temperature, the air pressure, the humidity, it will fit perfectly on that single day, but it will be useless at any other time.
So, if I spend months tweaking a moving average from a 14 period to a 13.5 period just because it made my equity curve look prettier over the last 2 years, that's overfitting, right?
Precisely. You are optimizing for a time series that will never, ever repeat. The true principle of the strategy, is it mean reversion? Is it trend following? Gets lost in the hyper-optimization. The actionable tip here is, if you cannot justify changing a parameter with a sound financial argument, not just a curve smoothing argument, you are likely overfitting. That's critical error number 1.
Got it. And that leads directly into a subtle, almost sneaky mistake: data snooping, critical error number 2. How are these two related?
Data snooping is an insidious form of overfitting. It happens when you test multiple strategies or hundreds of indicator combinations on the same historical dataset, and then you just pick the one that looks best. The inherent bias is that the market will always generate a random outcome that appears to work if you look for enough combinations.
It's like shooting an arrow and then drawing the target around where it landed.
Exactly. And academic studies constantly warn about this. You guarantee inflated performance because you're in a vicious cycle of self-confirmation.
So, we've covered flawed logic. Let's talk about the flawed foundation, the data itself. Critical error number 3 is using incomplete or low-quality historical data. What are the main pitfalls here?
The simple one is resolution. If your algorithm makes decisions hourly, but you're backtesting on daily closing prices, you're omitting crucial information: intraday pullbacks, spikes, and liquidity shifts. Your backtest might be buying and selling at prices that were completely inaccessible during that hour. It's like trying to judge the 2008 financial crisis by only reading the daily closing stock prices, ignoring the intraday panic. You lose all the intensity and context.
That's a technical error, but the next one is far more sinister from an investment standpoint, especially for long-term strategies: survival bias. This one truly inflates returns.
Survival bias is the ghost in the machine. When you backtest a 20-year strategy on a current index, say the S&P 500 today, that index only contains companies that survived. Your algorithm never encountered the thousands of companies that went bankrupt, were acquired, or were delisted due to poor performance.
The losers are erased from the record.
Precisely. Your backtest simulates that you never, ever invested in the failing stocks, drastically overestimating the real performance. This is why professional funds must use survival bias-free databases that include the prices and data of all the corporate ghosts. If you skip this, your spectacular return is just biased towards survival.
Execution errors. The friction of reality. Let's shift from data to execution. The strategy looks great, the data is clean, but when we go live, suddenly we're losing money. The friction of the market is the cause. Let's hit critical error number 5, ignoring real transaction costs.
This is especially brutal for high-frequency or scalping strategies. In an ideal backtest, you enter and exit at the exact market price at no cost. In reality, you have commissions and you have spreads, the difference between the buy price and the sell price.
And a small spread can be deadly.
Absolutely. Imagine a strategy that generates 500 trades a day with an average profit of 1 pip per trade. That strategy is completely destroyed if the actual commission and spread total 1.5 pips per trade. You're guaranteed to bleed capital. Your backtesting must simulate these costs with the highest fidelity possible. And frankly, I recommend slightly overestimating the cost as a safety margin.
A wise precaution. Which brings us to critical error number 6, unmodeled slippage. What is the key takeaway here?
Slippage is the difference between the price you expected an order to be executed at and the actual price at which it was executed. In the time it takes your algorithm to send the order and it to hit the market, the price has already moved.
So if the market is moving fast, or if I'm trading a large volume...
Exactly. Volatility exacerbates it. If you're trading a large volume in an illiquid market, you will push the price yourself, executing the orders at progressively worse prices. We saw this fragility in extreme forms during the 2010 flash crash, where algorithms experienced such extreme slippage, they were forced to buy and sell at inconsistent prices, causing multi-billion-dollar losses. You must apply a realistic slippage model to your backtest, even if it's just a simple 0.5 to 1 pip slip per trade.
Emotional and psychological insights. We've covered 6 major technical errors, but the last one, critical error number 7, is perhaps the most difficult to fix because it involves the mirror, confirmation and human intervention bias. Algorithmic trading is supposed to eliminate emotion, but the operator is still human.
This is where my role as a coach comes in. The persistence of the first 6 errors is 100% psychological. Confirmation bias means we ignore drawdowns, minimize the losing periods, thinking, I'll fix that manually. We only see what we want to see.
It's the ego wanting to be right.
It is. But the most destructive bias in live trading is intervention error driven by loss aversion. The algorithm executes a buy order based on rigorous logic. The trader sees the position in the red, gets gripped by fear, and manually closes it, thinking they're saving the day. But they've just annihilated the statistical logic of the strategy. If an algorithm relies on 51% of trades being profitable to win in the long run, every human intervention is an act of statistical sabotage.
So your advice is to literally trust the code you built and walk away no matter how scary that drawdown looks.
If you validated it correctly, yes. The only valid discipline in algorithmic trading is strict adherence to the code. If you feel the need to intervene, you need to go back and revalidate your confidence in the system before risking capital, not during the trade.
That's a tough lesson in discipline. Let's talk solutions. What is the professional triple validation protocol that separates the amateur from the expert?
It's a non-negotiable set of stress tests. Out of sample validation, this is the first, most crucial test. You split your historical data into 2 sections. Training, where you optimize, and testing, data the algorithm has never seen. If performance drops significantly in the testing set, you have overfitting and you stop immediately. Walk-forward analysis. This is the most advanced technique because it mimics live trading. You optimize the algo over a short period, say 2010 to 2012. Then you execute it in the next period, 2013, the walk forward period. Then you re-optimize using the new, larger dataset and execute it again. This simulates the essential need for periodic re-optimization in the real world. Robustness tests, or Monte Carlo analysis. Here you introduce small random perturbations, noise, to the input parameters, the trade order, or the size. A robust system will maintain positive profitability even with these variations. If the system collapses, it's too fragile.
That is the gold standard. It sounds like you are constantly trying to break the system rather than confirm it.
Exactly. We are seeking to prove its ineffectiveness. Only if it survives this rigorous attempt at falsification can it be considered genuinely valid.
So, a drawdown isn't a flaw to be hidden, it's a characteristic of the strategy to be understood.
That's perfectly put. You must understand